Okay, good afternoon. Today we will be talking about how we can use the income approach, and this approach is used for larger commercial real estate deals to really maximize our profits and returns. If you watched the video yesterday, we used the comparable approach, which is used for smaller residential properties, some smaller multifamily properties, but it's really limiting if we really want to push those rents and maximize the NOI on the deal, and we actually want to be rewarded if we reduce expenses and increase the rents, which is what real estate investing is all about. It's all about producing the best return possible for ourselves and if we have investors in the deal. So if you have any questions about real estate investing, or you think this real estate investing thing sounds pretty good, head on over to callseth.com and we can set up a quick call and chat about your real estate investing goals. So like I said, we have the income approach. And if you are doing any larger commercial deals, you will be using the income approach. This is the go-to method because it rewards the NOI, it rewards free cash flow in the deal, and other real estate investors are always willing to pay for that NOI, especially if it's a really good property as well. And we'll go into all those examples and details in a little bit. First things first, though, we have to learn what a cap rate is, because a cap rate is going to be one of the variables within the formula. So I know we're going to be covering a mathematical formula, and trust me, I sucked at math in school. It's the last thing I want to do, but when it relates to making money and expanding your portfolio, I think we can suffer through a couple minutes of math. So what is a cap rate? A cap rate is short form for capitalization rate. And a capitalization rate means, well, let's just use this example. Let's say I buy $1 million property and I pay all cash for it. So there's no debt on the property, it's just strictly cash. A cap rate is really the return, the potential return I can expect to get from that property. So let's say it's a cap rate of 5, so a cap rate of 5% on that $1 million property, all paid for in cash. I would be earning roughly 5% on my money a year. And we talk about a market cap rate, especially when we're getting into this formula. And whatever I mention market cap rate, all I mean is the return most investors would expect to pay to get paid in that market. So let's say a market cap is 6.5%, even though that's probably going to be hard to find these days. Let's say a market cap is 6.5%. That would mean most investors are expecting a return of 6.5% on their money if they paid all cash on the deal. So hopefully that makes sense. And I'll tie this back in once we actually do the formula. With cap rates are a good indicator of how stable investors feel a market is. The higher the cap rate, the less stable and the more inherent risk in that market. So let's say we have a low cap rate. Lots of places right now we're seeing between 4 to 5.5% if the market's doing really well. So that means that would mean that investors feel that market is very strong, very stable, and they are willing to accept a lesser return than, let's say, a 7 cap in exchange for that stability. Now, on the reverse side, let's say an investor is, let's say it's a small town in the middle of nowhere, not a whole lot of industry. An investor, for them to buy that building, would need a much higher cap rate, which would mean more cash flow for them to accept the risk. So maybe they'd be looking at a 9 or a 10 cap in exchange for the risk, because that market would not be as stable. So where's my eraser? Okay. So income approach. The formula is value equals NOI divided by the cap rate. And so the NOI means the net operating income. So all you do is you take the gross income and you subtract the expenses. A lot of people, I find, when they first start doing this stuff, they might use the gross income in the place of the net operating income, but we're always talking about free cash flow. And you know what? I will do another video on how to calculate the gross income, the net operating income, just because I find some people add in their debt service, so the debt payments, into the NOI, which is wrong. That's a below the line type of operation. So we will cover NOI at a future date. So let's use an example here just to figure out how cap rate affects valuation of property. So let's say we have a 200 unit property and we can say we're getting $1,500 a month from per unit. Let's say $1,500. So what's that? 3.6. Okay, so we'll say gross 3.6 million. And let's say expenses are hovering around 40%. So that would mean, I think it's going to be 1.440. If I'm wrong, put that in the comments section. Like I said, I hate math, but I think we're looking at 1.44 if I can add these zeros. So that would give us an NOI of 2160. There we go. Got it. So NOI of 2160. So let's look at how let's look at the difference of a cap rate of 6% and 5% and what difference that makes. So I will need my phone. Should have just used my calculator right at the start. So what we're going to do is we're going to take our NOI of 2.16 million and we're going to divide it by a cap rate of 6%. And that's going to give us a valuation of 36 million. Okay, so 36 million at a 6% cap with an NOI of 2.16 million. But now let's change it up and do a 5 cap. So 2160. So the valuation here is $43.2 million. So same amount of NOI, 2 different real estate markets and 2 totally different valuations based on the same income. So if we are looking at a 6 cap versus a 5 cap, and the buildings are relatively similar, I would say the 5 cap is going to be that larger metropolitan center with a strong job base experiencing lots of growth. So investors are willing to take that 1% difference in return in exchange for that long-term stability in the market and the confidence in that market. Whereas the 6 cap, maybe there's not as much major industry in there. So we won't go too much into that. So we know that cap rate can really affect the valuation of the property. So how, as real estate investors, do we use this to our advantage? Well, that's a really good question. And if you have any questions about any of this stuff, just go to callseth.com and we can set up a quick call and we'll actually go through this step by step and take our time going through a couple of different examples. So let's say we still have this 200 unit property and we're bringing in 3.6 million in gross income. And let's say we're in a 5 cap situation, which I don't think is unreasonable at this point. So let's say we have this 200 unit property and the previous sellers, they left some meat on the bones. So they didn't really find any creative ways of producing more income, because that's the whole point of value add real estate. We find a property where there is some value that we can add, whether it's reducing expenses, improving management, below market rents, adding additional income streams. So let's say with this property, 200 units, let's say we can add some parking, so upcharge for parking. We can have a valet trash pickup, so you can just leave your trash outside the door and somebody will come pick it up. Maybe we can charge for some storage. Maybe there's a storage space opportunity. So this is where the income approach really, really gets powerful. So we're going to have 200 units at, let's say we're going to increase, so $50 a month for each unit on average. So that's not too bad, especially if the rents are below market value. This is really easy to hit. So an extra $50 a unit times 200 units times 12. So that's $120,000. That's $120,000 a year, and we'll call these net numbers. So So now what we're going to do is we're going to take $120,000, divide it by a cap rate of 5%, and that's going to give us an increased valuation of $2.4 million. So another investor will be most likely willing to pay an extra $2.4 million just for that increased revenue stream. This is the power of the income approach when it comes to these large commercial deals. It rewards creativity and it rewards property management and operations. If we're looking for properties, we're looking for that value add where we can bump rents up. So if we can, and as you can see, even a $50 difference per unit over 200 units, we have the scale's working for us. That increases the valuation by almost $2.5 million. Now, another example. So let's say we have the same thing. What was the NOI we were working with before? I think it was 2160. Okay. Well, even if it wasn't, we're going to run with it, NOI. Okay, so let's say we're finding a property right now, and it's in a transitioning neighborhood. Maybe it's like a B- property, and it's really a B+ neighborhood. So the neighborhood is gentrifying, which means it's improving. More people are putting money into the neighborhood. So let's say we buy this property at a 5.5 cap. So 21. So all I'm going to do on my phone, actually I should probably find a way to hook up my phone screen to the screen here so you guys can see the math I'm doing. So 2160 divided by 5.5%. So that gives us a valuation of 39, and then we'll just say 272 million, just to keep it really easy. Okay, so this would be our purchase price. Now, this is where the income approach really puts things on overdrive. So we're going to add an extra $50 a unit with our value add game plan, whether it's parking or extra services, you name it. So that's an extra $120,000 to the NOI. So our new NOI is 2280. So let's say we're doing some other renovations to the property. We're going in, we're changing up the kitchens, we're adding new flooring. Maybe we're changing up the pool if there is a pool, doing some landscaping. Bring that property from that B- to that B+. That really fits in that neighborhood. So let's say over the next couple of years, the cap rate, the market cap, has gone from 5.5% to, let's say, 4.8%. So this is where that value add component really comes in, because we're able to change the property. So we're taking an asset maybe that was underperforming, under market, and really bringing it up to market, or to that B+ level that we were talking about. So now all we're going to do is take 2280. We're going to divide it by 4.8%. So now, we have $47.5 million valuation just from doing the right renovations on the property and by increasing the rent by $50 a unit per month. This is the big impact, and this is what's rewarding the creativity in the deal and property management. So if you have any questions about this, I know the whiteboard looks kind of messy right now. If you have any questions, go to callseth.com. We can have a good conversation about the income approach and how we use this to pump up the returns on these larger commercial properties, especially multifamily real estate in my case. So like I said, hop on over to callseth.com. Hopefully this gave you some good ideas about how you can use the income approach to really maximize your returns on your real estate investing. Thanks a lot. Have a great day.